Welcome back to the deep dive. In this lightning-fast world of crypto and DeFi, keeping up sometimes feels like a full-time job, doesn't it?
It really does. Almost overwhelming at times.
But, every so often, something emerges from all that noise. A moment that, well, it feels different. It feels like a real strategic opportunity. And today, we're zeroing in on one of those, AFEX, and its recently upgraded AI DeFi staking protocol. We want to look at this like a shrewd strategist would.
Exactly. Our mission here isn't just to say what AFX staking AFX is. It's to really break it down meticulously.
Make it clear.
Make it crystal clear, yeah. And highlight the advantages, from that strategic angle. What's the visionary potential here that might attract really astute investors?
Right, not just what's happening.
But why it matters, why this specific thing stands out strategically from everything else happening in the market.
And what really grabbed me is that our source material calls this a golden window, that phrase. It suggests something valuable, maybe fleeting.
It definitely builds intrigue. It implies time sensitivity, high value.
Okay, let's unpack this. What makes it so golden?
So let's set the scene. The date was September 15th, 2025. AFX puts out this pretty significant announcement. It's about upgrading their AI DeFi staking protocol.
And this wasn't just a small tweak, was it?
No. Not at all. It was fundamental. It changed how you participate. Moving forward, staking now requires a 1.1 ratio. AFX tokens paired with USDT.
Okay, 1.1 AFX and USDT. What does that mean practically for someone wanting to stake?
It means you need equal value of both. So
Yeah.
if you stake, say, $100 worth of AFX, you also need to put in $100 worth of USDT alongside it.
And pairing it with USDT, a stablecoin, that seems intentional.
Oh, absolutely. It's a deliberate design choice. It helps anchor the pool, potentially dampen some of the volatility you'd get just holding AFX alone.
So it's kind of a built-in balancing act within the stake itself.
You could say that. It's a strategic move, likely designed to, build confidence and maybe attract capital that's a bit more risk-averse than pure DeFi deedens.
That definitely sets it apart from a lot of the single asset staking we often see. But okay, here's what sounds like the really critical piece. The rewards.
Ah, yes, the reward.
They're limited. Right, like really limited.
Explicitly, irrevocably limited. There's a fixed pool. Only 30 million AFX tokens set aside for these staking rewards. Full stop.
The source even used a Thai phrase, "Kar pumpu," which basically means
once they're gone, they are gone. No more will be created for this. It's not a tap you can turn back on. It's a reservoir that's draining.
And that's what creates the golden window, the scarcity.
That's exactly it. What's fascinating here is this finite resource. It's not just a minor detail. It's the core mechanic driving this whole thing.
How so?
Well, it intentionally creates urgency, right? That can drive quick adoption, pull in liquidity fast for the protocol.
Makes sense. Fear of missing out, FOMO.
Yeah, classic FOMO driver.
Yeah.
But strategically, it also makes you wonder, doesn't it? What happens after the rewards run out? How do they keep people engaged?
Good question. Is it just a short-term boost, or is there a plan for afterwards?
That's the million-dollar question, isn't it? The answer will probably shape where AFX goes long-term.
Okay, so understanding that finite nature, that urgency, how does a smart investor actually play this? Let's get into the strategic blueprint.
Right, the actionable steps.
Step 1 seems to be about getting in at the right time. The source mentions an investor, Vidier, buying AFX around $1.16. Why that price? It was called a support zone.
Okay, yeah, support zone. For anyone less familiar with charting, think of it like a price floor.
A floor.
Yeah, a level where historically buyers tend to step in quite strongly. It's a price that has previously stopped the asset from dropping further.
So buying there limits your potential loss if things go south.
In theory, yes. If that support holds, your immediate downside risk is somewhat limited. It's like playing defense before you think about offense.
And the offense is if the price goes up.
Exactly. If you bought at support and the price does rise, your potential capital gains are amplified because you started from a stronger base. It's calculated risk management.
Of course, no floor is unbreakable, right?
Absolutely not. Support can fail. But strategically, entering near a known support zone is a common tactic to improve your risk-reward ratio.
Okay, that clears up the entry point strategy. So you've bought your AFX smartly. What's next in this blueprint? Staking.
Staking is the foundational tactic here. Once you have your AFX and the matching USDT, you stake it. You're essentially locking that capital into the protocol.
But it's not just sitting there.
No, it's working for you. That's the beauty. You don't need to be glued to price charts, stressing over every little dip and spike.
Because
You're passively earning more coins. Every day, more AFX tokens land in your wallet from the staking rewards. Your holdings just grow steadily.
Okay, so it turns the asset into something productive, generating yield.
Precisely. Continuous yield, regardless of the immediate market noise.
And this brings us to what the source calls the double gain. This sounds like the core advantage.
It really is the heart of the strategy.
Hmm.
It offers two distinct ways to profit, happening at the same time. You don't have to choose.
Okay, break down the two layers for us. Layer 1.
Layer 1 is your classic capital gain. You bought AFX low, maybe at that $1.16 support. If the price of AFX goes up, the value of your initial investment goes up. Simple as that.
Standard crypto play. But layer 2.
Layer 2 is the passive income. Remember those daily staking rewards. You're constantly getting more AFX tokens. So you're not just hoping the price rises, you're actively increasing the amount of the asset you hold.
Ah, I see. So even if the price stays flat for a bit, you're still accumulating more tokens.
Exactly. And if the price does go up, those extra tokens you earned also become more valuable. It stacks.
Which loops back to the urgency of those limited rewards.
Absolutely critical. The source puts it bluntly. Whoever enters faster is at an advantage.
That water scooping analogy.
It's like scooping water from a pond. The earlier you scoop, the more you get. It's vivid because it's true in this case. It's a finite resource.
So it's not just about getting some rewards, it's about maximizing your share before the 30 million run out.
Correct. Once they're depleted, that reward stream stops, period.
Yeah.
So your entry timing directly impacts how much of that limited reward pool you can potentially capture. It's a huge strategic consideration.
That scooping water idea really drives it home. It almost reminds me of like early Bitcoin mining. The first ones in got a disproportionate share.
That's a very apt comparison. We have seen similar dynamics, these bootstrapping mechanisms in other DeFi protocols, often with huge initial success attracting users and liquidity.
What's the lesson learned from those, though, about what happens after the initial rush?
Well, two main things. First, the early mover advantage in these models is massive. Get in early, get the best rewards. But second, and maybe more importantly for the long run, the protocol's survival, its long-term success, hinges on what happens after those juicy initial rewards dry up. Does it have real utility? A strong community? Other reasons for people to stick around?
So AFEX limited reward window is a strong play for initial traction.
Definitely. But the real visionary potential, the long-term win, depends on what they build beyond just this initial staking phase. That's what savvy investors will be watching.
Okay, let's make this really concrete for everyone listening. Walk us through the example. How does this double gain actually look in a portfolio?
Let's visualize it.
Imagine you take the plunge. You stake 100 AFX. You bought them at that strategic $1.16 price. So you also need
116 USDT to match it 1.1 in value.
Right. So at that moment you stake, your total investment in the pool is 232 USDT. Seems straightforward.
Pretty simple math so far.
But
now let's see what happens if the AFX price starts to move up. This is where the double gain kicks in.
Okay, scenario 1. AFX hits $2. What happens to our 100 AFX?
Your initial 100 AFX are now worth $200. Add your 116 USDT, and your total portfolio value in the stake is $316.
So 232 USDT went in. Now it's worth 316 USDT. That's carry the one. A 36% profit just from the price going up.
Correct. That's your capital gain.
Yeah.
But, and this is crucial, you're still getting those daily AFX staking rewards on top of that. And guess what?
Those rewards are also worth more now.
Exactly. Each AFX reward is now worth $2, not $1.16. So your passive income stream itself has become more valuable.
Okay, let's push it. What if AFX goes even higher, say $3?
And now we're talking. Your initial 100 AFX are worth $300. Add the 116 USDT, and your total portfolio hits $416.
Wow. From 232 USDT to 416 USDT. That's almost an 80% profit just from the price appreciation.
That's the power of the capital gain layer when you get your entry right.
And this really highlights the compounding effect, doesn't it? It's not just the initial coins appreciating.
Precisely. Those daily AFX rewards you're getting, they become way more valuable as the price climbs. That one AFX reward per day isn't worth $1.16 anymore. It's worth $3 in this scenario.
So you're earning more tokens, and each token you earn is worth significantly more. It's like a double whammy of growth.
That's a good way to put it. It accelerates the expansion of your holdings.
Is this what the source means by the snowball effect?
That's exactly the concept. Your initial stake is the small snowball at the top of the hill. As it rolls, Fueled by both price gains and staking rewards, it picks up more snow, gets bigger, gains momentum.
And potentially becomes a much larger snowball by the bottom.
Exponentially larger,
Yeah.
potentially. It's about harnessing that compounding force, making your capital work much, much harder for you over time than just simple linear gains would.
Okay, that all sounds fantastic if the price goes up. But let's be real, this is crypto. What if the price doesn't go up? What if AFX dips after you stake? How does the protocol handle or maybe mitigate that risk?
That is the crucial question, isn't it? Every smart investor thinks about the downside, and this is where the design shows its strategic depth, potentially creating what we call that win-win mentality.
Okay, explain that. How is it win-win if the price drops? Say AFX goes to 0.90 cents.
Well, obviously, the immediate dollar value of your staked AFX goes down. That's undeniable. But, and this is the key part, you are still accumulating more AFX tokens every single day from the staking rewards.
Ah, so your token count is still increasing even if the price per token is lower temporarily.
Exactly. While your portfolio's USD value might fluctuate, your underlying asset base, the actual number of AFX tokens you hold, is constantly growing. You're accumulating.
It's kind of like dollar cost averaging, but you're not buying the dips, you're earning the dips.
That's a great way to think about it. It's like DCA supercharged. You're effectively lowering your average cost per AFX token over time, simply by holding and staking.
So when the market does eventually recover, you're positioned to benefit more because you have more tokens.
Precisely. It provides a bit of a psychological buffer too, I think. Seeing your token count increase daily gives you a sense of progress, even if the market is choppy or down. You know you're building your position for the future.
That definitely adds an important layer of resilience to the strategy. Okay, so let's pull this all together. What are the absolute key strengths that make this AFX staking thing stand out?
Let's lease them out.
1. Locking in value. Getting in at a strategic price like $1.16 sets you up to amplify gains later and hedges against buying higher.
2. Growth-oriented rewards. Getting paid in AFX means your passive income appreciates if AFX appreciates. That snowball effect we talked about.
3. Early mover advantage. That 30 million AFX limit means getting in sooner gets you a bigger slice of the reward pie. It's a direct incentive.
And 4, the big one, dual profit streams. Passive income and capital gain potential working together. You don't have to prioritize one over the other.
It's not just trying to buy low, sell high then. It feels more structured.
It really is. It feels like a more sophisticated, planned approach. It's taking principles like, accumulation similar to DCA and blending them with DeFi staking mechanics. It's quite clever.
And it builds in that resilience.
That's the win-win aspect. Even if the price stalls, you're still winning in the sense that you're accumulating more assets daily. You're always increasing your holdings, always growing your position for the long term.
Which really underlines why this specific event, with these specific rules, is being called a golden window.
Exactly. It's for those who see the mechanics, understand the limited reward structure, and grasp the strategic implications. It's about the compounding potential baked into this particular setup.
It's not just about AFX itself, but what a strategic investor can do with this opportunity right now.
Couldn't have said it better myself.
Okay, so summing up. We've looked at the strategic timing, those powerful dual profit streams, accelerating growth, and the very real-time sensitivity of this golden window with AFX's AI DeFi staking. Definitely a calculated play.
And really digging into this, understanding these dynamics, it's not just about AFX, it's about sharpening your strategic eye, empowering you, the listener, to make better, more informed decisions in this incredibly dynamic market.
Seeing the whole board, not just the pieces.
Yes.
Exactly. Anticipating the next moves.
Right. So as you think about all this, here's something to chew on.
Yeah.
What are the broader, long-term implications of these kinds of limited window opportunities that pop up in DeFi? And maybe more importantly, how can really understanding protocol economics, the why behind the rules, empower you to spot, analyze, and maybe even seize the next big strategic advantage out there?